Ladies and gentlemen, welcome back to another video. I'm your host, the Dividend Aristocrat, and in today's video, we're going to be taking a look at my most recent addition to the portfolio. Now, as you may have noticed, I have not posted in quite some time, but I do want to work my way back up to posting weekly investing content once again. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, although I wasn't posting in the meantime, I have continued investing pretty heavily. In total, I've invested $62,822, and my portfolio value currently sits at $94,714. Now, this is significantly higher than the last time I made a video, and we are quickly approaching that $100,000 mark, which a lot of it has to do with my recent gains in the portfolio. Now, the past couple months in terms of performance have honestly been incredible. I've reached an unrealized gain of over $31,000, and my total return in terms of percentage is about 50.76%. Now, since starting the portfolio, I've earned $2,800 in dividend income, and going forward, I'm projected to earn over $1,350 per year, giving me a portfolio yield of 1.43% or a yield on cost of 2.15%. Now, just to take a quick look, this year so far, I've invested almost $10,000 and we're only about halfway through the year, and I've received $400 worth of dividend income. Now, this video is not meant to be a recap of my portfolio. I do want to make a pretty detailed update in the next couple of weeks if I have the chance, but I just wanted to give you guys a quick overview of what's happened since I last posted. Now, without further delay, my newest ticker symbol is Intuit, ticker symbol INTU, and I started purchasing it in the past 2 months or so. So my initial purchase was 3 shares at $347, and I thought it was at an attractive valuation already, but I didn't want to go too heavy because I could imagine that we might be seeing some further drawdowns. Regardless, I thought it was a good price point to start my position, so I bought about $1,000 worth and then continued to dollar cost average down as the price has since dropped pretty significantly. You can see here a month later I bought 3 more shares, but the price had dropped down to $320, then 2 more shares at $300, 2 more shares at $280, and now most recently last week I purchased 2 more shares at $263 per share. Now, of course, it would have been ideal if I could start my position all the way down here at $263, but it's pretty hard to time the bottom on these stocks, so it might continue declining or it might start trending upwards. We'll have to see over the next couple of months. Now, there are several reasons as to why we have seen such a decline in stock price over the past couple of months in this company, and one of the big ones revolves around the AI fear. Many investors and shareholders believe that AI is going to consume the moat of Intuit, and that's going to eat away at its earnings and therefore bring its intrinsic value down over the next couple of years. Now, that does pose a significant threat to the company's fundamentals. On top of that, tax-related revenue from their TurboTax division was not as great as anticipated, and the problem with that is we have to wait an entire calendar year to find out how they do next year for tax season. And if that wasn't enough, there's also an antitrust lawsuit against Intuit right now, so we'll have to see how that all plays out. Now, that being said, I'm personally willing to take the risk right now and start purchasing a position in the company, though I will try to moderate it between 3 to 5% of my portfolio value. I think long term the company does have a decent amount of potential as it has some pretty strong business units aside from TurboTax. Now, we will have to see how this ages over the next couple of years, but I'm really hoping that it has a positive ending. Just taking a look at my position, it is my worst performing stock in the portfolio, down over 13%. I've purchased 12 shares in total at about $3,700, and my current value is sitting at $3,204. Scrolling over to the right, I haven't earned any dividend income just yet, but the yearly dividend per share is $4.80, so my annual payout would be about $57.60, and I am getting it at a pretty decent yield on cost. My yield on cost is at 1.56%, but for every share I'm buying today, I'm getting it at a dividend yield of 1.8%, which is historically high for Intuit. Now, the main reason the yield is high right now is because the stock price has come down, but the dividend has remained the same, so as the price to earnings ratio has compressed, we're getting a higher dividend yield on our cost. Now, in terms of allocation, I'm already at 3.4%, which is already a full-size position in my opinion. Anything around 3% I consider to be full-sized, but I am open to making a larger position in the portfolio. Now, that will depend pretty heavily on how they continue to do on their earnings reports. If they keep coming back pretty strong, but the company keeps trading down, I'll keep adding into the position. Now, taking a look at some of the company's financial metrics, the first thing we can see here is this incredible drawdown that they have had over the past year. To see a clearer picture, we can jump into Google Finance and take a look at the company's performance. In the past year, it's down almost 65%, which is insane. Just year to date alone, it's down over 57%, making it the worst performing stock within the S&P 500. Jumping into the S&P 500's year-to-date return, we can see that SanDisk tops our charts at over 820%, and then we have Western Digital Corporation at over 333%, which is all just insane. Now what you guys can also see up here on the list is Intel Corporation. And if you remember, I posted a video, I believe 2 years ago, where I was buying the worst performing stock in the S&P 500, which happened to be Intel. Since then, it's clearly wound up being my best performing investment in my portfolio, which is pretty crazy to see. So now I do think it's time to replicate this experiment and buy the worst performing stock in the S&P 500 for this year. Scrolling all the way to the bottom, that unfortunately does give us Intuit. It's down over 59%, and even when I made my initial purchase, I believe it was the worst performing stock at that time as well. Now, only time will tell if this experiment works out yet again in my favor. If it does, that'll be amazing and I'll have some pretty strong returns in the portfolio. But if it doesn't, this could end up pretty badly for my allocation in Intuit. Regardless, I do think it's a fun experiment. I think it's a high quality company and is worth the risk to put some money into it. So going back to performance, we can put the 5-year chart and you can see that from peak all the way down here to the bottom, it's down over 66%. Now that being said, based on our financial metrics that we can take a look at here, the company has continued to deliver every single year. Now whether this will hold true for the future, I still don't know, but we can see the revenue per share has continued to increase pretty aggressively, and the same thing can be said for earnings per share and even free cash flow per share. Now during that time, shares outstanding have gone down, though I do imagine that they've gone up recently, probably for some sort of acquisition or some stock-based compensation. Now, speaking of stock-based compensation, we can see here as a proportion of free cash flow, and it is pretty large. They do give out a huge amount of stock-based compensation, which I do hope that they start slowing down in the future like we've seen in companies like Uber. Their dividend has grown pretty consistently every single year, but I assume that with this drawdown, it's going to start growing a little bit slower than before. In terms of net income margins, they have pretty good margins, especially on that TurboTax segment. It's almost pure profit for them, and their capital expenditures are relatively low since they're basically a software as a service company. Now jumping into Seeking Alpha, what I wanted to show you guys here is their price to earnings ratio, or basically some of their valuation metrics. So on a non-GAAP basis for the trailing 12 months, they're actually only trading at an 11.59 price to earnings ratio, which is historically extremely cheap for them. Their 5-year average sits at 37.41, and even for their forward price to earnings ratio, it sits at 34.5, which is now trading at 11.2. Now this company has not had many big drawdowns and there are not many opportunities to buy it at such a steep discount, but of course there are reasons to why it's dropping so significantly. Now something that I do personally recommend is taking a look at their GAAP metrics. What you can see right here is that their price to earnings GAAP ratios are actually significantly higher than the non-GAAP, and that's because of the absurd amount of stock-based compensation that they do give out. Now for their GAAP price to earnings ratio, they do take that into account, so it's about 16 for each, which is still significantly lower than that 5-year average, and honestly lower than most of the sector as well. With the rate that the company has been growing, which is 15% year over year, and expected to grow about 13.5% in revenue going forward, I think that's a pretty good bargain. Now it's important to think at a further time frame than that, which a lot of investors are doing, and that's why they're selling the stock right now. They expect earnings to continue to slow down and eventually even decline. Now, if that does happen, then of course this would be a terrible investment, but if earnings continue to grow in a double-digit range, eventually the price should correct itself. So that was just a quick breakdown on my recent purchase in the portfolio, which is the worst performing company in the S&P 500 year to date. We'll have to revisit this stock over the next couple months as well as next year and see how it's performing by then. If we are lucky and see a recovery like what Intel had, then this will end up being a pretty good opportunity to buy a great quality company at a discounted price. If you did make it all the way to the end of the video and you did enjoy it, leave a like. It really does help the channel a ton, especially since I'm trying to get back into more consistent uploads. Let me know down below as well what your thoughts are on the company. I know sentiment is pretty low right now, but price does dictate sentiment, so we'll have to see how this pans out. Now remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.